You have one single sentence in your report. This time around, it's not the Friday jobs report. It's the Thursday, Friday jobs report, because the optimists are hanging on claims. How important are claims?
Well, that's really a critical question when it comes to this employment report on Friday for November. Jobless claims has been surprisingly resilient for a very long period now. It's beginning to look more not like a soft landing or hard landing, but more like a long-term landing. We're waiting more and more and more for any evidence of either a sharper slowdown or an acceleration. And what we do have on the labor market on the slowdown side is, as we'll get today, the JOLTS data has been showing the quits rate has been coming down, meaning the number of people who voluntarily quits their jobs has been declining. The number of job openings has been coming down. The work week has been coming down. Wages for job switchers relative to job stayers has been converging. In other words, you no longer have as much bargaining power if you change jobs. Combined with the number of people who are changing jobs for permanent reasons has also been changing. So the conclusion is we still have more and more evidence pointing in the direction of the labor market softening. One indicator, jobless claims, yes, still good. Okay. But basically everything else is pointing in the direction of what you would expect, namely a weaker labor demand.
I want a single point non-farm payrolls estimate, but they won't serve me the bacon John was talking about. So let me go to this. Is the whisper number finally turning towards, it's a look down, a set, what is it, John, 188,000 we're at?
That's consensus, median estimate, yeah.
I mean,
but that includes the UAW.
Which is about 30
But is the whisper number coming down instead of going up this time around?
Well, if you really back up and think about what's going on, the Fed hiked rates in March of 2022, and your textbook would tell you when you raise interest rates, you should expect to see consumption begin to slow down, capex spending begin to slow down, credit growth from the banking sector begin to slow down. And all those things are happening. And all those things should also be expected to hit, in particular, lower rated credits, smaller companies, middle market companies. And that's exactly where you're beginning to see signs of weaker labor demand. So you should expect to see non-farm payrolls over the next several months do what the Fed is expecting it to do, namely gradually be softer and softer.